AT&T stock is in the news because they are currently at a 30-year low. Guys, in our software, just based on price, since the beginning of our data feed from 1987 or so, AT&T is only up 105.5% in terms of stock price. Now, keep in mind, it's at a 30-year low. So going back to 1993, it's at a 30-year low. But in that time period, you would have also collected $43 in dividends along the way. So it's a little misleading to sit there and say your total return was even over the last 30 years. Now, there are issues with AT&T. In this video, I'm going to go over these. I am doing this literally off the cuff, as most of our videos are. This has gotten a lot of attention. I even got a lot of tweets from people saying, hey, Paul, are you going to do an AT&T video? And I said, guys, it's coming tomorrow. So today we're going through AT&T. We're going to go over some beginner things, some more advanced things. So no matter where you are in the spectrum of investing, there's something in this video for you. We're going to go over analyst estimates, some of the ideas I have about this company, about reasons why I may or may not like it. And then we'll also go through a stock analyzer at the very end to sit there and determine, is this a company you want to buy? So let's go over a couple of key ideas here real quick. So again, guys, this company is currently selling for $14 per share. $14. And over the last 30 years, it has paid out $43 in dividends. So one of the benefits to dividends is, even though, guys, if they had not paid these dividends out and kept the money in the account, the stock should be much higher because you have a lot more value in there with a bank account. A lot of people think that dividends are just extra money, free money. They are not. If they come out of the business's bank account, it decreases the balance sheet's value. That's the big thing I want everybody to remember. So, one of the biggest things I have here, it's a $100 billion market cap company, $100 billion. But here's the difference here with enterprise value. Their enterprise value is $390 billion. So if you're new, you're probably like, what the heck is enterprise value? This is if you bought the entire company, paid off all the debt, and got the cash in your hand. You'd still end up paying $390 billion. There is $200 billion, $300 billion in debt on the company. Now, just as an example there, let's pull up a company. What's another company with a $100 billion market cap? Let's look up Pfizer. I don't know what Pfizer's market cap is. Oh, $200 billion. But let's look at it this way. $205 billion on Pfizer, and their enterprise value is $278 billion. So they have a lower enterprise value because they have a lot less debt relative to their market cap. So again, market cap is buying all the shares outstanding. Enterprise value is buying all the shares outstanding, paying off all the debt, and taking all the cash with you. So it nets all those things together. Okay, now, the company did $121 billion in revenue last year and lost $9 billion. But look at their cash flow, was $14 billion. $14 billion. Okay, so this is an example of where cash flow and earnings are not in line. Let's see if we can figure out why that is. I'm going to go to the income statement here, and usually, other income and expenses, a minus $21 billion. Now, a lot of times, guys, this is a write-off. So nothing has actually occurred in terms of cash this year for that money. It's just a write-off. That's why there's a difference between cash flow and net income. And look how different that is from, oh boy, look at the last few years. They've had almost $38 billion in write-offs plus a $4 billion gain. Now, as an investor, you should look up, what is this $21 billion write-off? So guys, the key here is to research these one-time expenses and even income. So if you look back at their history here, big write-off, big gain, big write-off, big write-off, big gain, minor, 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 minor. So the key to look at these things is saying, okay, if it's a consistent thing where they're constantly expensing something every year, you've got to basically say, listen, they're just in the business of expensing things. But if it really is every once in a while, don't worry about that stuff. Yes, they make bad investments here and there, but I would focus on the cash flow here. And that's what we have with that significant cash flow. That significant cash flow. Now, because of spin-offs and things like that, that might be a reason why the cash flow is lower, because look at their cash from operations has decreased. Guys, the biggest thing for me is this freaking debt. I just look at this debt and go, wow, that's a lot of debt. So what is the average? So one of the things to do would be to figure out the average interest expense on their debt right now. That's $300 billion in debt. And if the average interest is hypothetically 3%, but we're in an upward interest environment, when they have to refinance that, if it goes to 6%, what happens to their interest expense? 3% difference on $300 billion is what? $9 billion. That's going to eat up $9 billion of their cash flow. That's a big concern. But currently, they're currently selling for $100 billion divided by 13, 7.7 times their cash flow. So basically what that means is if you got this cash flow 17 years in a row, then you basically be getting all your money back in terms of the equity in the business. Okay? But again, companies with debt, just like you people, just like us, debt can be a reason why things go poorly very quickly when things go bad. That's the risk with debt. My personal opinion is whenever I see a lot of debt in a company, I just say, you know what? I don't know if I want to deal with that. There are a lot of listen, I look at this thinking to myself, they have $300 billion in net debt, right? So enterprise value, and they had made $13.7 billion in cash flow last year. That's 21 times last year's free cash flow. My goal is to have 5 times that. And it's 21 times. That just seems like a lot. But let's go see what analysts are saying. Well, actually, let's go to our 8 pillars first. Oh boy. Now remember, guys, if you have our software, you can customize the pillars to be up to 12 pillars and like 4 quadrillion different variations. But let's look at these. PE ratio is low. Makes sense. Price to free cash flow is low. Now, they had spinoffs. With AT&T spun some things off, so I think their 5-year free cash flow is a little misleading, but it's still very low. But everything else is just an X. Wow. This probably has to do with the spinoffs, losing the revenue and net income. Well, this has to do with the big write-off. Guys, I think for me, when I look at this company, analyst estimates, let's see what analysts are saying. I mean, look at this, guys. Where's the growth in earnings? There's no growth in earnings here. They're expected to make $250, $248 this year in earnings and going up to $267 in December of 2027. This is coming from analysts who are supposed to be optimistic people. Look at revenue. Oh, man. Guys, my personal opinion is, let's look at stock. I'm going to do stock analyzer tool. And the reason being is I want to show you that it's probably going to look good in the stock analyzer tool. And let's see how it actually comes out. So let's just do this. Guys, this is the tool we use. It was used 1.3 million times last year. All of these tools are available, include that everything you've looked at, plus all of these, and the community here of thousands of investors you can have this exact conversation about. I'm sure the thousands of people here, a couple hundred have researched AT&T, can probably tell you a lot of things about AT&T. What's that $21 billion write-off for? What's the average interest on the debt? These are the things that people can discuss in here because it's easier to invest and research as a group than it is individually. So let's sit here and do some revenue growth. Let's do -2, 0, and 2% revenue growth. For profit, remember the profit was skewed here. Remember, this stock analyzer tool does not include the balance sheet at all. That's a very important key here. We're not factoring the balance sheet at all in terms of any value to the balance sheet. So profit margin. 10 years, they did about 7.7%. 5 years, 4.8%. Last year, obviously, because that big write-off. So I'm going to sit here and call it normalized 5, 7, and 9%. Free cash flow, I'm going to do 8, 10, and 12. PE, 12, 14, and 16. Same with price to free cash flow. And for my desired annual return, guys, there's a lot of risk in this company because of the debt. And if I can get 9 or 10% from investing in a long-term ETF, the question I need to ask myself is, what desired return do I have here? The higher my assumptions, the more my desired return should be, which is a bigger margin of safety. And all of these are subjective. You have to make certain determinations here. The goal here is whatever prices you see below to determine is it an obvious buy or not. And if you like the price, go do more research on that debt. So please stay with me because even through the end of this video, because I'll be explaining a lot about these prices that pop up below and what you should do next for AT&T if you're interested. So for desired return, 12.5%, 15%, 17.5%. Hit the analyze button. Oh boy. Wow. So a low price of 6 to 10. And by the way, if all the low assumptions occur and we pay today's price, you'll make about 7.5%. A middle price of 9 to 13. And again, if all the middle assumptions occur, you're going to make about 14% return. And the reason it's in red, guys, for both of these is we had 12.5 and 15% for our required return. And for the final one, 12 to 16 with a 21% potential return if the highest assumptions occur. So guys, before you go, let me just say, for me personally, and again, you should do your own research. Don't do anything because I'm doing it. If you like this company, because if you look at the dividend yield here, what is the dividend yield in the company? 8%. I think they're cutting that though. But there's a huge dividend here. If you like the company, you need to understand the debt. You need to understand what happens if debt covenants don't get hit. And if you don't want to do that yourself, that's why you join the community. Everythingmoney.com, $1 per day for 7 days. That's your intro. That alone is worth it to try it out, just to look at AT&T and determine if it's a scary company or not. For me, it's just the too hard pile, so I'm out. Thank you very much for your time.